Hi everyone, it's Chat about another video. Today I'm going to be talking about UiPath. Released its results after the market closed last night. It's down 17-18% after hours. Came to around 12% today on a generally quite good day for the market, particularly for growth stocks. It's right above its 52-week low of just $12. It's now $13.74, down 68% year to date, down even more from its all-time highs. Significantly down from its IPO, it's now just a $7.5 billion company. Particularly juicy looking acquisition target for some of its major competitors and some of the larger companies in the world. I'll analyse whether this company worth buying for the future, whether it's a buy or a hold, go through its most recent earnings and its prospects for the future. So like and subscribe if you enjoy the content. Let's get into it. So getting into the quarter, numbers are actually pretty good on the whole. Revenue up 24% year over year to now $242 million. The annualised revenue run rate up 44% year over year. Both of these were above analyst expectations. The earnings per share, which is not on here, was way above analyst expectations, while still not turning a profit of any kind. GAAP gross margin around 82% compared to that non-GAAP gross margin of 84%, which was down slightly year over year, but the GAAP gross margin number of 82% is still very impressive, and we realistically need to see that number be above 80% for the long-term success of this business, and it's definitely a number I'm going to be keeping out for. They're still recording losses, spending a lot on sales and marketing. This increased quite dramatically. Research and development also up around 30%. General and administrative costs also up slightly. This is to be expected. This is a company that's scaling. It's investing heavily in the growth of this business, and that is the right thing to do in my opinion, and it's going to be a decent amount of time before this company produces cash flows to speak of. That's $1.7 billion in cash and no debt, so I'm not at all worried about the future of this business whatsoever. That is more than safe enough position for a $7.5 billion company. So why was the stock down 15%? Well, although it beat expectations on the revenue and earnings per share front, the guidance was pretty weak. The next quarter they're expecting pretty much the same revenue, very little quarter over quarter growth. Annualised revenue run rate of just shy of $1.1 billion, and for the full year, $1.15 billion of annualised revenue run rate. They're expecting $1 billion in revenue, and it's still going to be recording operating loss. Basically, it's a bit softer than Wall Street wanted, and that's because of effectively because of foreign exchange. It's causing real big problems for this company. They're losing a lot of money on foreign exchange. They're actually doing a lot better when you normalise for that, but that's a reality for this business, that they're struggling with foreign exchange. They lost a bit of business because of the Russia situation, and they're just not really performing as strongly as they would like because of these external factors, which are pretty much out of their control. But overall, I think this is a reasonable quarter. I think it's probably a little harsh to see this company going down 12-13%. So looking in summary, this company is now looking at around $1 billion annual revenue, global customer base 10,500 and growing significantly. They now have 1,660 customers producing over $100,000 in annualized renewal run rate. This is growing 44% year over year. They have a really impressive dollar-based net retention rate of 132%. So when you exclude the foreign exchange impact and Russian sanctions, which of course unusual external event, but they did happen, so we shouldn't exclude this, but just for information, this should be around 135%, which is a very strong number of course, and is run at 80% gross margin. All these are very impressive. This is of course a company that trades for a reasonably high valuation, so it's to be expected that it will need to record impressive numbers and maintain this, but on the surface, a company that's growing its revenue run rate of 44% as a large and expanding customer base, is a leader in its field, and has 130% plus dollar-based net retention rate. These are all very impressive to me. The business's key metric, of course, is ARR, and it's been growing this at a really impressive rate, 55% compound annual growth rate over the last 2.5-3 years or so. And this, while this is decelerating clearly, just 44% in the most recent quarter compared to a 55% average over the last 3 years or so. This needs to at least maintain above 40% in my opinion for this to be considered a business moving in the right direction. I expect some deceleration as this is now a company that's getting into the billions of dollars of run rate. So it's not going to continue growing at 50% forever. However, I really need to keep it at a minimum of 40% over the next few quarters for this to be considered a business that's rolling on all cylinders. UiPath has again been recognised by Gartner as one of the leaders in its field for the 4th year in a row, with highest overall position for both ability to execute and completeness of vision. It's around, depending on where you look, around 25-30% market share in this industry, which is predicted to grow at a really strong compound annual growth rate over the next few years, which will of course make this a very impressive investment if it pans out. It is not without competitors by any means, and some of these are quite serious competitors. You can see on the list IBM, which are not really doing anything of note, but looking at the lower end of that list, Salesforce, Appian, Microsoft right below UiPath. That is a serious threat to this business in the long term, is that Microsoft could just eat the lunch and perhaps could even acquire this company. They are a huge cash pile, and UiPath is at a really depressed valuation right now, or well, depressed to what it used to be. So acquisitions are definitely possible for this company in the future. While I don't think that as an investment thesis, it certainly would be nice for people buying in right now. However, I still think this company is going to be one of the market leaders for RPA, and I have seen no reason why it won't continue to be for the intermediate term. It's important as a market leader to not rest on your laurels and to be building on this momentum. That is exactly what they're seeing at customers. They're seeing strong customer momentum. They've added over 1,500 customers in the year over year. They're scaling those large customers, so they're up around 30% in customers with greater than $100,000 in ARR, and they're becoming a C-suite priority. Customers that are greater than $1 million ARR, that has increased dramatically year over year, almost doubling, which is really impressive to see. These companies, this is a sticky platform, and this essentially makes a moat. High switching costs and a sticky platform makes this very difficult to get rid of, and therefore gives it a moat over its competitors. Overall, I think a 12% decline on the day is perhaps a little unfair. I think the report overall was pretty good. Revenue beat expectations, earnings per share beat expectations. The guidance was a little weak, mainly due to external factors that they can't control. But this is generally a business that is performing well, that is executing on it, and is maintaining its market leader status and moving in completely the right direction, in my opinion. So I wouldn't say it's rolling on all cylinders, but it's executing absolutely fine by my estimations. Of course, it is an objectively highly valued stock. It doesn't record any profits to speak of. So it's not objectively cheap by any means, at around 8 times sales. So this will be held to a higher standard. It was down 12%, down 20% at one point in a day that was broadly quite good for growth and high valuation stocks. So it could have been a lot worse. I think 12%. I think the board of UiPath will be pretty happy with this after seeing it was down 20% at one point. Overall, I like this company. I am an investor in this company. I have a very small stake. It's a very small percentage of my portfolio. However, I do like this company. I like what it's doing. I think robotic process automation is here to stay. I think this company will be able to maintain its market lead, and at the very least will be an acquisition target for a company like Microsoft perhaps. I think the ability of a company like Microsoft to eat UiPath's lunch is very real, but I think that is an eminent possibility for all small disruptors, because any industry that Microsoft, Google, the big tech companies go into, they of course have the potential to do this. But I think UiPath, with the customers it has, it's proven that it's got a very sticky product, it's building its moat, and generally it is considered a very useful platform and is a market leader in its field, so it must be doing something right. Do I think the stock is a buy right now? Probably not. I think it's probably about a hold. It's performing well. Could it be performing better? Yes, absolutely. And I think the valuation is still a little high. I'll be maybe adding if it continues to go down in the next few days, but right now the wind is very much against these type of companies that are valued highly on price to sales basis, and in an inflationary environment, I'm not sure I want to be adding at this type of valuations with profitability as far away as it is. However, if it goes below $10, I'll definitely be adding for sure. With that being said, no, this is financial advice. Like and subscribe if you enjoyed the video. Do your own research and due diligence, of course. Don't just listen to what I'm saying. Let me know if you think this is a buy, sell or hold. Let me know if you think this is a junk company or a future titan of industry. Whatever you think, let me know down in the comments below. I'll see you again next time.